Right, here we are. Welcome everyone to Economica. Today we'll have a brief, hopefully, video about a econometrics study that I performed on inflation and interest rate, just two variables, starting from the standpoint of what is the medium wage purchasing power across time. So let's start with it. And when done, I just observed from the ONS data the income distribution by quintiles from, as you can see, from 1977 up to 2023, and these are the income distribution. So these are the top earners that briefly went above 70,000 per year. The median income, which is this all individuals, is overlaid on the third median, the green line. It's about 34,462 pounds per year. So the bottom quintile is a bit more than 15,000 per year. So these are the time series of the income distribution in the UK economy by quintiles. And so I decided to discount or interpolate this income distribution with the inflation, and to see what is the real purchasing power of the average Brit. So we see that this is the same graph, income distribution, but it's adjusted for CPIH, which is Consumer Price Index harmonized, and includes all items, even volatile items, which are food or energy or housing cost, rental, occupation, utilities, everything that any worker, employed person, or professional, or any manager has to pay, whatever. So the income distribution, and they are pretty much the same, as you can see. You see that the median income is peaked in between in 2020, and it has decreased in 2023 at levels that are before more aligned with 2018-2017. So there has been, from just observing the graph, you can see that the line goes down. So the income on just on an income base, they have decreased, and then that means that with higher inflation, the real income or purchasing power of the average person has decreased more. So adjusting for inflation, so it's net real income for the blue line, which is the bottom quintile of the income distribution, real income has grown only by 5,493 pounds. It says here 1989, but we saw before that the time series starts in 1977. So I think that it was aligned with the inflation data, probably. Anyway, so it's 1989. So let's say in 34 years, the real income is only improved by a little bit more than 5,000 pounds for the lowest earners, which are probably a good chunk of the population that works for the minimum wage, or is part-time work, or low-skilled occupations, or whatever. Then the second quintile, which is the orange line, the real income in 34 years has grown only by £9,000, which is very little. The median income, we saw that median income now stabilized about 34,400 a year for the median household. The real purchasing power is improved only by £10,000, £11,000 in 34 years. And we have the fourth quintile, and then we have the top earners. So there is a very large gap between the top earners of the income distribution and the vast part of the workforce. So, well, these are related to other dynamics, but we can see from here that the real income for the at least the first three quintiles and median earners, they have improved very little in 34 years. And this is a factor to consider in what are the spillover effects of inflation in the economy and the ability of any consumer to spend or to invest or to buy an asset or basically improve life prospects. So only a small cohort, the top earners, have seen a considerable increase, which is more than a 20,900 or almost £21,000 real income increase in 34 years. It's more than the average income of the second quintile or the bottom quintile earners, because we can see here, we can stay on this graph, yes. You can see that the blue line, which are the lowest earners, they don't add up £20,000 a year as a wage, as income. So the top earners have seen the real income increase more than the nominal income of the lowest earners. So these are some disalignment or divergences in the income distribution in an economy that cannot be, of course, changed, because these are private sector dynamics or also public sector, I don't know. But I mean, to any this real income improvement is almost equal to the nominal wage of the second quintile. This is the real income improvement of the second quintile, £9,000. Sorry about that. Oh dear. Oh, come on. Okay. So we see that the average annual income of the second quintile is maybe between 24,000 pound a year, 25,000 pound a year, and the top earners have seen their real income preserving their purchasing power discounted for CPI inflation by almost the same amount. So I mean, the income distribution and top earners, they have eaten away these two brackets of the working population. Well, let's go forward. So what we've done forward, I just went back on the ONS, a lot of data, and we extrapolated the CPI table and the ONS only, the data starts only from 2005, so this is a discrete time series study, 2005, 2023. And I coded for changing from the index to the percentage change month to month, and I asked Jupyter or Python, as you wish, to calculate, please, the quarterly standard deviation for every year. So we have Q1, Q2, Q3, Q4 standard deviations for the CPI inflation. And these are the periods, which are 2005 to 2023. So these are the quarterly standard deviation. This is the annual average standard deviation. And from these data, we can begin to see that, I'll try to, no, it's already quite large, that there are, for example, periods of high volatility and periods of low volatility. And from the annual standard deviation, we see that the standard deviation is some years where it starts with low volatility, then slowly builds up, and then goes down, and then builds up again. So these are there is some sort of cyclicality or clustering of volatility in certain periods. Going forward, this is the graph of the chart for the quarterly standard deviation in percentage point of inflation. And so we I asked Jupyter to show me what was the PDF and CDF function. So I try to understand what is the skewness of the distribution, if there are divergences from the standard normal distribution, and if to validate on a certain point if there is volatility that diverges. So you can see that the Q1 graph of the PDF function is it fits a normal Gaussian distribution with a slight pronounced right tail skewness on the right side. Same is for the Q3, although the Q3 standard deviation data values, they are higher. But we can see that in Q2 and Q4, the normal Gaussian curve, it's it isn't the same, but it's more of a chi-square distribution. So there is a skewness in the distribution of volatility of standard deviation of CPI. It means that the CPI inflation diverges from its median average, and this happens, for example, in Q2 when it begins to show up with a right tail skewness, and then we have a peak of high values, higher than normal values here in Q3, and then there is also a somewhat of volatility in Q4. So these are also determined by seasonal factors. And we can see also in the CDF function, the Q1 and Q3, they match. So the step function, which is that comes out from the data, it almost matches the path of the black dashed line, which is supposed to be what is the normal cumulative distribution function. But we can see that in Q2 and Q4 there is a wide divergence of the step function from what should be the normal path of the cumulative CDF function distribution. So with this graph, sorry about that, we have determined that also for what we can see from the data, that the standard deviation of the inflation measure has some skewness and diverges from its average mean, and this means that there is volatility, there is sometimes a very high rate of change in the rate of inflation, and this happens in some periods that build up and they peak, and then they auto-regress. So this means that inflation by no means is stable in the economy, especially in the digital economy, where prices can be changed very rapidly on any website. So this is a factor to consider in evaluating the monetary policy framework, because in the digital economy we have many price changes which are not captured by normal statistical observation of surveys, what is the ONS or the BLS or the Eurostat, and so the standard deviation of even the single items in an inflation basket should be considered to see how much prices are deviating for what should be the price stability of the average price of a certain time period. So going forward, we take the same results, data set, and ask Jupiter, please, can we figure out for the standard deviation that we have, how many basis points we should hike or cut in an interest rate benchmark for monetary policy. Sorry about that. So Jupiter came up with these results and gave us the average Q1 standard deviation, 0.1585, the average for Q2, 0.24, Q3, 0.25, Q4, 0.18. So we see that from these averages, we see that in Q1 we have a lower standard deviation, and that picks up in Q2, and it picks up. I mean, the volatility in inflation increases by 0.9 points in Q2, and then peaks in Q3 with summer season, I mean for our hemisphere, and then it tails slowly in Q4, which is Christmas season, but still remains volatile. So the overall average standard deviation for the discrete time series, which I recall is from 2005 to 2023, it's 0.2124. And we assume, we say, okay, we want to follow what central banks say, and we want to have a CPIH 2% price stability, and we would allow a 1% deviation up or down from the 2% aim. So it could be 3% or 1% above or below the 2% target. And for this to activate the response function of the central banks only through the interest rate tool, to dampen inflation or to stimulate demand, or in this case the code that we have with Jupyter, it's based on other studies, more important studies of inflation volatility, and it says that basically normal standard practice in central banks is that for a 1% increase in volatility there should be a 10 to 25 basis points hike in the base rate, the bank rate, because we are, here it's specified 1% increase in volatility, so well, increase it could be either ways, but so the parameters are set that we can allow a 1% deviation on the rate of inflation, and we would allow 15 basis points for every run the code, and we had the same result. So the we have here the average volatility difference basically is 0.21 subtracted by 0.01, and we have very simple estimated hike. It's a rate hike multiplied standard deviation difference by 100, and we have 300 basis points. So if there is a 0.20 as the standard deviation in inflation, there should be theoretically 300 basis points in hike in interest rate from the 2% base, so it will be a 5% rate. I mean, this is somewhat of very much of a theoretical construct, because this is just a reaction function to, and in this instance we don't have incorporated the or shall we say the interest rate time series, something that we will see in a bit. What else we should consider is that basically we could consider this data on the basis of 1, 2, or 3 sigma. So we would consider on the basis of 3 sigma, so 100% of the data. So that would be that a 3 sigma of 0.2024 average standard deviation for the whole data set starting from 2005 to 2023, it would mean that inflation on average diverges by 0.60%, not 0.6%. And if that will mean that on average inflation it's 2.6 or 64%, something thereof of that magnitude, which is that doesn't require a 5% interest rate for the bank rate. 2.6% that will probably require a 4.6% or 4-ish percent interest rate, or something thereof. So so we should try, for example, to see if we want to fine-tune this thing. Let's try to 10 basis points. Let's see, that's 200 basis points. If we want to have 12, so it's just, yeah, more or less. If you want to fine-tune the thing, it would be, for example, that if on average on the whole data set we know that CPI incorporates a 0.20 or 21 standard deviation across time, which is persistent, it indicates that there is a persistency in the volatility of the rate of inflation, and it's difficult to keep it at 2% aim. We want to proportionate that for as we say, for a for a 1% change in volatility, we want to have a 10-12 basis points hike in or cut in the bank rate, the base rate of money market rates. So that if we start from a 2% base, we have a 240 basis point hikes. That will be the bank rate at 4.4%. That will be reasonable compared to a 2.6% CPI. If we consider, as we say again, a 3 sigma multiplied the 0.20 standard deviation, we have a cumulative 2.6% CPI that is persistent across time. So what else? How we can explain ourselves? So what we tried to do has been to implement some other volatility other econometrics time series analysis to understand what is the behavior of the CPIH in this case. And we have run a few codes here, which are you can see an AR1 and ARIMA 100 and ARIMA 101, and also GACH and eGACH models. And we found some interesting results. Let's see if we have the graph. Probably yes, hopefully. Yep, here we have it. It's a bit of a nightmare to see the whole graph. Let's see if we can, expand the thing. It's a lot of computation for my machine. So these are the graph for the fitted models for observed quarterly standard deviation. This is based on 75 observations, so it's quite a narrow data set. And 5 variables, because it's 4 quarters plus the average annual standard deviation of CPIH. So the blue line is the raw standard deviation, and the green line is the ARIMA, and I don't know if it's predicting a high volatility going forward. And the dashed line, they are the GACH and APACH models. They all converge to the AR model, which is to the average value, probably not a little bit more than 0.2 in standard deviation. But what we have here is that the ARIMA models, those are that fit the most, they explain the most the behavior of the CPIH. So, and we can try to interpret some of the values, and we see that, for example, this coefficient of 0.8, oh dear. Now, sorry about that. Oh, what have I done? Sorry again. So we have here and the constant of coefficient, 0.2172, is a significant coefficient at 1% level. So there is quite a level of accuracy in the model. Although the this AR lagged with the one lag coefficient is not very statistically relevant for how the AR, the ARIMA with one lag, fits the data set of the standard deviation. And to confirm that the ARIMA 100 doesn't fit completely the CPIH, we can see that also the this Lumbox data is not significant, statistically significant, and that we can see that from this test, the Jacques-Barrot test and the heteroscedasticity test, that the data set has the distribution of the data is some skewness, some heteroscedasticity, so there is variability in the for the standard deviation of CPIH, and we have pretty much the same results with the ARIMA 101 that fits better, because the constant value here, the coefficient, it's pretty much similar to the ARIMA 100, so it's significant at 1%. But the ARIMA 101 with one lag is a 0.90 coefficient. This is also significant, and also the moving average, it's as a statistically significant coefficient. Also the sigma 2 fits the model, and as we said before, testing for the heteroscedasticity of the model, we see the Jacques-Barrot test and the heteroscedasticity highlight some do tell us, although in a very difficult manner, that the data set of the standard deviation of CPI has some heteroscedasticity, so there is a lot of variability in the inflation model, and that there are periods of high inflation that may be followed by periods of low inflation, so there is clustering of, as we saw that Q2 in the second quarter of the year, there is an increase in the rate of inflation in the variance of prices that is captured in the broad index, and these peaks with the highest volatility in Q3, like in summer season, where people travel or drive more or go out more. There is more services, hospitality services, or entertainment, leisure, holidays, flying tickets, concert halls, so all sorts of things that are less in demand in winter time. And we run some Gash models which can also help to see what is the change in volatility. The most useful model is the ARIMA 101. Okay, so from this we have done a very detailed study of the behavior of just one variable, which is CPIH, starting from the income distribution, trying to explain how the volatility in the rate of inflation, how prices can change very rapidly, and this is also a factor that hinges on the real income, the purchasing power of the median earner. What we've done next, it's we have gone on Fred and ask Fred, please Fred, can you give us the interest rate time series for, in this case, is the sterling time series. We have to keep it all together. So it was inflation, UK inflation, CPIH, and real income. And this is the Bank of England time series that we have matched it starting from 2005. It has a few quarters more of data because it has up to Q3 2024 of interest rate, and we see some basic data, which is the median interest rate in the past 25 years. Past 19 years. Has been 1.77%, which is well below. It's below the 2% inflation target, and it should be higher than that. I mean, but we have experienced a decade of 0% interest rate. We see here very, very low interest rate, never getting to the 1% benchmark. That will have caused all sorts of discontent among financial asset managers, but as we can see, that we should have considered more the rate of volatility in inflation to fine-tune the interest rate tool, also in a period where we are running QE, and we want to have a very low rate of interest rate, which is could have been not very appropriate for the time, because then other asset bubble build up. This is I mean, ECB was negative interest rates, so also, I mean, the Bank of England has been mostly positive. But the aim of my study is to consider the standard deviation of inflation instead of the mere percentage change of prices, because we can see that from this simple mechanical thing that for a 1% deviation in the rate of inflation on this 1% in standard deviation volatility, we can assume a 10-12 basis points hike is required in the bank rate to keep pace with inflation and to somehow contain with the forward guidance, for example, the inflation expectation. So we see that probably incorporating the standard deviation variable, I mean metric, for inflation, that would make the reaction function of the central bank more proactive, or in forecasting that inflation it could be rising in following quarters, because we see that there is clustering in volatility of inflation. So if we see that inflation is the variability of prices is increasing, we can try to foresee, to forecast with an ARIMA 101, for example, if the volatility is going to increase, and then there we can build up in our model that probably we need to act, and that money supply or the interest rate tool has to be activated to anticipate what should say an anchoring of inflation expectations, instead of waiting for the data to feed through month on month and quarter on quarter in the measure of price, which it's slower and less responsive survey or statistical measure that can capture can immediately identify the the variability of the rate of inflation that it's happening in the economy, although we can have high frequency data and we can measure prices like instantly on transactions, but I'm sure that the standard deviation measure it's a very important tool to be utilized for monetary policy. I mean, that is my core idea. So we got the interest rate. We said, okay, Jupiter, please give me the quarterly standard deviation. We done exactly the same that for CPIH and the average annual volatility. We see that volatility in for the bank rate, it's quite low. It's much lower than inflation. It has completely different behavior, but we can see that, for example, in 2008 we had 1.16 standard deviation in the rate of change of interest rate, and in 2022 we have recently experienced another high level of volatility for interest rates. Also 2023 has not been very quiet for interest rate decision. That means that these are periods where there is a sudden rapid change in interest rate. That also because, yes, many people say that the bank is behind the curve in seeing how the factors the macroeconomic factors in the economy are changing, and this should be analyzed from a standard deviation standpoint rather than a percentage price change in the case of inflation, and also in many other variables. Because we know from financial markets that the standard deviation is the most sensible measure to see what is the volatility, what happens when the interaction in markets heightens volatility or dampens volatility. So it's the market participants that determine and anticipate what could be most rapid, wider price changes rather than stable prices. And so there should be a very similar approach for retail prices. I'm sorry. Because any shop must have an online retail point, like giants like Amazon, Alibaba. They can change price every day. So, and they have no control because they give the service to the actual private retailers. They adjust. And we know that there is a process of bidding and price competition between retailers that utilize Amazon or Alibaba or other like eBay. And so the dynamic of prices is very much changed with the digital economy, and we should adapt. And as I said, for example, if we want to go to a concert hall and we see that there is this unfortunate phenomena of ticket hoarding and reselling. So we have some other private ticket resellers that they buy tickets in bulks and then they sell it again on and the price is inflated by 1, 2, 3, 5 folds, 200%. Some other things they are reported in the telly as how much I couldn't find the Oasis ticket, and if we found the ticket, the price was astronomical. And this happens, for example, transportation. So if, for example, tomorrow the railways has a major problem in the railway infrastructure, we see that immediately the prices of flying tickets, they spike. So there is a immediate volatility of flying services for transportation, because there is not supply for railway transportation, and this will be the same, for example, for Uber, which Uber or this shared gig economy taxi services. We see that they are designed for bidding of algorithm. If there is more demand in that area for pick up some passenger and drop it somewhere else in town, we see that the algorithm beats up the price of the service for the driver. And so these are whole sets of variety of dynamics in the retail prices of services and consumer or goods items that have to be measured by the standard deviation. They cannot be measured. They cannot be statistically measured by price changes, because the price changes multiple times a day. A statistical survey, it only captures what is the median price of that day, but it comes after some time, and the data is worthless basically. So it should be a combination of high frequency data and volatility, and this has to be built in the model and see how volatile are becoming prices, so that monetary policy is more reactive, is proactive in assessing, for example, in evaluating, forecasting if volatility is rising, if the economy is overeating. I mean, these are all very complicated things that so here we have the table of the quarterly standard deviation for the interest rate benchmark, and we had some interesting statistics, because we asked Jupyter to say, okay, please do a comparative study between the CPIH standard deviation quarter on quarter and the interest rate. So what we got here is that the linear regression factor between the two measures is not very significant, and so it would be more appropriate to have a linear regression between the standard deviation of inflation and the raw data of interest rate, not the standard deviation of interest rate, so that to see in proportion what should be the rate of what has been in a time series, what has been the reaction function of the rate of change in interest rate in basis points compared to periods of high and low volatility, if there has been any response at all by the central bank, which I doubt it. So what we can observe is that the standard in the correlation matrices, we see that having a starting point of standard deviation, it gives us an immediate reaction function, impulse response function in the between the two variables, but then this response function is less effective when in the following quarters. So of course this tells us a very important thing, that the interest rate tool is effective in the immediate consumer behavior and the immediate inflation expectation, because when the bank hikes interest rate, then the consumer immediately knows, oh my god, the cost of money is going up, so I'll have to cut back immediately on spending and set aside money for other expenses. So this is visible in the data, and it's also visible that the correlation coefficient then fades away in the following quarters. So the famous long and variable legs is not very relevant for the standard deviation dynamics between inflation and interest rate. So, for example, we can see here just the Q4 CPI column has a 0.67 correlation coefficient of Q3 interest rate standard deviation. So we see that there is a 1 quarter lag. It's the following quarter we have a reaction on the rate of on the volatility of inflation, and vice versa. But for example, we see Q2 CPIH as comes up with a 0.60 correlation coefficient with Q3 interest rate. So there is 1 quarter lag of correlation dynamics between the volatility of the rate of inflation and the volatility of the rate of change of interest rate. But if we if we prolong the quarters, we see that the effect should fade away. I was pretty sure about that. Yeah, we see, for example, Q1 CPIH and Q2 interest rate, it has a negative correlation coefficient, while, for example, Q1 on Q1, it has a very high correlation coefficient. So the transmission mechanism of inflation interest rate volatility, it has a moderate to consistent correlation coefficient, 0.69. And for that, we asked Jupyter, please give us some graphs so that we can understand more or less what that means, those correlation coefficients. And we asked Jupyter for a moving average, smoothed moving average. And we can see that the moving average of the blue dashed line is the inflation rate, is being consistently above the interest rate moving average. Also because, as we mentioned, there has been a long period of very low interest rate. But we see here, for example, in the period between 07 and 09, that the moving average of the quarterly standard deviation interest rate is spiked, is increased very much above the moving average of inflation. So that means that interest rates have been decreased very rapidly, more of the rate of inflation, or increased, I believe decreased, because of a financial system shock, for example. And in the latest period, we see that the interest rate moving average has drifted, has showed some higher standard deviation, but it has been below by 0.2 points the blue line, which is the rate of inflation. So we see that the response function for the increase of money supply and energy shock and the demand shock for the reaction function of the central bank has been very slow. It's been a lot behind the curve, and this has determined another series of spillover effects of the persistency of inflation, which is already incorporated in the time series that we saw before, that for a whole data set that goes from 2005 to 2023, the average standard deviation quarter on quarter is 0.2124. So there is a 21.2% volatility in the rate of inflation, which is persistent, is built up across time. So we see here that Q1, they are mostly correlated. Yeah, they had been mostly correlated for the 2007-09 period, and these are not. There's not much interpretation in these graphs, but what I took most is the moving average to see how on average the two variables have behaved across time. And so you see Q3, the quarterly standard deviation in inflation is very, very high, between 0.2 and 0.4. So Q3 is the seasonal factor that we see a peak or high of in the volatility of prices, of retail prices, goods and services prices. And what else? So we asked for a VAR model. So say, okay, we want to see the impulse response function. We had the first VAR model, but then from analyzing the data, we asked for, please Jupiter, we need an optimal, you want to know what are the optimal lags, and we see here that the optimum lags are 3 from the AIC parameter, if I don't make a mess of everything. Okay, yeah. So we have some results which are quite complicated to understand. So we will I will go through these two graphs, which is the autocorrelation of the square residual, and we see that they are mostly well behaved. There is no lagged autocorrelation in the square residual errors, and so we can assume that the time series, although it's not, there are 75 observations, not very large time series, it's stationary, and that there is some component of randomness. So the impulse response here, this graph and this other one, these two in this diagonal, or the anti-diagonal, those are the ones to consider. So we have, if we have an impulse from the interest rate in the standard deviation, what happens? What is the response of in the volatility of inflation? So we see that if we have a 0.25 change of interest rate, for example, or in the standard deviation, we have a reaction which is a broad range, the dashed black line, of plus or minus almost 0.75 in inflation. But this reaction is larger in the immediate following quarter, but then it narrows down, fades away. Yes, but we see that the reaction function in inflation is 3 times the impulse of interest rate. So following is the same. If we have a 0.4 or 0.5 CPI standard deviation, what happens is the response function in the standard deviation of interest rate, it's plus or minus 1 standard deviation, maybe more. So and this is quite relevant in the immediate from 0 to 2 following periods, or the 4 following periods, but it then narrows down. What we were trying to we said that the optimal lag length for the VAR is 3 lags. So we asked Jupiter to give us a 3 lag VAR to see if his goal is this VAR, goal, no goal, offside. What's going on with this? What happens? Then we have the results from the CPIH equation and the interest rate equation of the standard deviation. And we see that the probability data for one lag, it's significant at 5%. So again, it is to reinforce the concept that the one lag effect of inflation, it's relevant, but then it's less relevant in the in the following legs, in the following quarters. As we see here, the one-lag effect. Sorry, just lost in translation. And see, these are the graphs for the optimized lag VAR, and they are pretty much the same. So what else to say? It's been a very interesting study. I hope you enjoyed. It's very I hoped here at Economica I will keep it short. It's been a very lengthy video. Thank you if you follow all my description, and yes, I'll wait for your comments if you enjoyed the video, if you have watched the video, and I'll see you again. Good luck.